Okay, welcome to the December 13th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about the USDA report that was released on Friday and the sort of surprise, well, it was a surprise to me. I know there are some analysts that have different opinions than I do on feedstock use following the EPA's mandate release. But I was surprised by the relatively small decline that USDA projected for soybean oil use as a biofuel feedstock, and then go through our typical sort of margin review and talk about our credit price forecasts. Okay, so let's get started. I'm going to try and do this again, but it hasn't been working. I've put in a ticket, so I apologize. I don't understand why this doesn't update. I did this last night, so it would update today. Anyway, so USDA only cut their forecast for soybean oil use in biofuel production by 200 million pounds. And they remain well above where we expect usage to be. Now, I think the difference is in the way that they may come at predicting feedstock use versus the way that we come at predicting feedstock use. And I think that the two approaches may provide sort of bookends on potential feedstock use. So the way that we do it is we look at the mandates and then we get some volume of renewable diesel and biodiesel production, and then we translate that into feedstock demand for each of the feedstocks. And we take the regular sort of biomass-based diesel mandate, and then we add the undifferentiated advanced portion to it, and then we also add the gap between ethanol production to it. And then we look at capacity utilization, and we try to balance capacity utilization against the against what the mandate implies that renewable diesel and biodiesel production need to be. However, the mandates that the EPA released showed only a relatively small increase in production year over year, while capacity is expected to grow substantially in 2023 relative to 2022. And so it was difficult to get on our side, it's difficult to get the utilization rates up to a level that sort of makes sense. Now, what we kind of assume is that not all of the projects that have been announced will come online on time. And so by the time that we get to the month that has relatively low utilization rates, that capacity may be lower than we project, and so utilization will be higher than we project. I think the way that USDA has come at this, and I think that it's the way that some other analysts have come at this, is they've looked at the growth in renewable diesel production capacity, and then they've assumed, and I think correctly, that the plants that open are going to operate at 85, 90, 95% capacity. And then they've based their production forecast on that, and then that's driven their feedstock forecast. And so I think that if you think about approaching it that way relative to the way that we approach it, kind of what you're assuming is that as an industry, that it will produce RINs above what are required by the mandates, and that effectively the RIN bank will increase year over year. Now, historically, the RIN bank has been substantial, and in the last couple of years, it's drawn down to the point where there have been well-researched and written articles that suggest that the RIN bank is close to zero or potentially zero, or we could sort of run out of RINs. That was more in 2020 that people were saying, well, we potentially could run out of RINs. But even in 2021 and in this year, there have been, it seems like the opinion is that the RIN bank is low relative to where it has been historically. So in theory, I think you could say that, yeah, having the industry sort of rebuild the RIN bank back to where it's been historically could make some sense. It certainly is a position that I think is defendable, and especially given this idea that the renewable diesel facilities are going to open, and those that open are going to run at capacity that's close to their nameplate capacity. However, I think you could also potentially make the argument that over the last couple of years, there have been at least some companies that have shifted their view on RINs and the accumulation of RINs, I guess, for lack of a better way to put it. And some of the airlines are a prime example of this. So one of the airlines has had accumulated a fairly large RIN deficit, and at some point had kind of said that that with RIN prices where they weren't really expecting to meet their mandates. If there are enough companies that have sort of taken that approach, then I think it's going to be difficult for the industry as a whole to build the RIN bank. Now, it may be that there are just a couple of companies that feel that way, and the industry has, as a whole, the projects that are coming online are well financed and are under construction in some cases, and so are going to open, and then they're going to run, and whatever happens to the RIN bank happens to the RIN bank. I think that may be sort of the most likely scenario that we're in right now. And so as a result of that, I think that, again, probably our forecast and USDA's forecast may be sort of bookends on where production will be and where feedstock demand will be. It wouldn't necessarily surprise me if our forecast for feedstock usage rose a little bit. If it does, it will only change our balance sheets sort of modestly, and it won't change them. It may reduce our ending stocks forecast, and I wish I could put the balance sheet up here to talk through it. It may reduce the ending stocks forecast a little bit, but if not this last week, it was the prior week, I raised my forecast for exports to 1.5 billion pounds. And I did that because I think that given the change in the mandates, we probably are going to, at least in the short term, kind of restructure again the relative basis. So if we think about RBD basis as crude basis plus a refining margin, the idea has been that growth in renewable diesel production means that crude basis is probably going to increase. The refining margin is going to shrink because a lot of renewable diesel producers have pretreatment, and so they're going to buy crude instead of RBD. And so the new equilibrium crude basis level is going to be higher, substantially higher than it was last year or historically. And in addition to and that would also have some impact on the Gulf basis. And the Gulf basis the idea was the Gulf basis would remain well supported for two reasons. One, because crude basis was just higher, and then two, because we needed all of this feedstock. And so the domestic basis would rise, and Gulf basis, in order to be competitive with the domestic market, would have to rise. But as a result of that, the Gulf basis wouldn't be as competitive in the world market. And that's exactly what we've seen. The spread between the Gulf basis and basis out of Argentina is still 17 cents or 17.75 cents or something. And even though that has narrowed a bit in the past week, that gap still means that, you know, weekly export sales data is probably going to remain historically low, and we're going to get a very slow, at least start to the 22-23 export season. Now, the increase to 1.5 billion pounds would assume that at some point Gulf basis would also come down, and then U.S. export sales would rally. I think that is kind of a long shot a little bit, but I still think that it's at least possible. Now, in the week or so since the mandates were announced, we have seen crude basis start to come down, but we haven't seen Gulf basis move down hardly at all. So Gulf basis has dropped from, I think, 9.50 to 9 cents, whereas crude basis in Central Illinois has dropped from 7 cents to 5.75 cents or something like that. So if ultimately I need to raise my feedstock demand, I probably will just take it out of exports. USDA has kind of gone the opposite way, and they lowered their export forecast down to 1.1 billion pounds. I had been down in that area, 1.25. I think at one point I may have been at 1.1. And again, only raised it in part because of this idea that maybe Gulf basis would drop. I don't think that I have any huge argument against USDA's number, and especially not given the start that we've had to the export season and the fact that commitments are as low as they've been in a very, very, very long time. So I think that, again, probably as I move feedstock demand out of soybean oil or into soybean oil, raise my feedstock demand forecast, I probably will just offset that with a decrease in exports. The other place that I could cut a little bit maybe is non-biofuel use. So my non-biofuel forecast has been at 14.5 billion pounds for a little while now, primarily because when we got the October NOPA data, it implied that non-biofuel use was really strong. November data sort of backed that up as well. Sorry, maybe it was the October data did it. We haven't gotten the November data yet. But it looks like it's only 1 month, but if you look at it relative to history, there's not a slowdown, and certainly a slowdown could occur over the rest of the year. But in order for that to happen, you probably need RBD basis to rise above where it was last year. And at this point, that seems unlikely. And it doesn't mean that we can't get back to where we were last year, remain steady, or I guess we could potentially rise a little bit above it, but probably not significantly above it. And so that means that non-biofuel demand is probably going to be above 14.2 or 14.3 billion pounds, and we're at 14.5. So there's another little area that I can kind of trim a little bit, add to feedstock demand, and then I don't really have to make other big changes in my balance sheet. The other thing that is a bit different between USDA's forecast and our forecast is the average price for soybean oil in Decatur, crude soybean oil in Decatur. And that, I think, is primarily due to our assumption about crude oil basis going forward. Now, I've started to cut those forecasts. I had crude oil basis rising up to, I think, 10 cents at one point. So I've started to shave those down. And as we see where crude oil basis is really going to go, I'll make further adjustments to that. But that contributes to a spread that between USDA was at 68 cents, and I think we're at 72 cents or maybe a little bit more than that for the average price for crude soybean oil and indicator during the 22-23 marketing year. Now, I think that the idea that sort of my price forecast, or at least the crude basis projections, are sort of at odds with this idea that that exports could be 1.5 billion pounds. In order for that to happen, I think I would need to cut my crude basis and then my Gulf basis pretty substantially from current levels to really get to 1.5 billion pounds. Or I guess what I'm really saying is, if I really believe in the 1.5 billion pound number, probably my Decatur soybean oil average price forecast should be a little bit lower. And I will probably end up in that spot, but there are sometimes as an analyst where I don't really want to, after a big event like the release of the mandates, I don't want to make real drastic changes to my forecast and then have to come back in a couple of weeks and sort of completely reverse those. There are still times that happens, unfortunately. But especially after big events, I tend to be a little bit more conservative in the changes that I make to my forecast. So I think that the sort of the 70+ cent forecast for crude soybean oil as an average is probably not a bad forecast, and I think USDA is probably going to have to come up. But again, I think that there probably is there's a little bit of a potentially it's going to need to be one or the other that changes, or maybe even both, in terms of my export forecast and then my my crude soybean oil forecast. So I say all that just to kind of explain where I think there is some risk in my outlook. I think as an analyst, I could sit here and say that, you know, this is exactly what I think, and this is 100% what's going to happen. But again, particularly after there are substantial changes in the background, I can go through and make the changes that I think make sense and talk to you about why I make those. And then I think the most important thing to highlight is, in my forecast, where do I think there's probably the most risk that I'll need to make additional changes. And so that's why we're doing that part today. For canola oil, USDA made some changes to its US forecast that included a 150 million pound increase in its forecast for canola oil used in biofuel production. Based on the timing, I think you could say, oh, well, the EPA released the final pathway for RIN generation from renewable diesel for canola, and so USDA raised their forecast. But I don't think that final pathway was a surprise. I think everybody kind of knew that was coming and probably had included it in their projections already. I think that probably more likely it was a function of the recent strength in canola oil used in just biodiesel production. So the EIA data has been sort of 130 million pounds a month here for a little while. And then sort of anecdotal reports suggesting that some of the renewable diesel producers were buying canola oil in anticipation of the final pathway. I think if you sort of combine those two pieces of information together, you can get and it sort of makes sense that you would then raise your canola oil feedstock demand forecast. And so I think it's probably more likely that was the driver than the pathway, but it may have been the pathway. I don't know. And at the end of the day, it doesn't make a huge difference why they did it. Their increase took their forecast up to like 1.5 billion pounds, which is just above ours, which is like 1.45 billion pounds. We don't expect huge amounts of canola oil to be used in renewable diesel production. We do expect, some, I think, about 300 million pounds a year or so to go into renewable diesel production, at least in the short term. Maybe it grows as we get into the out years, especially if you look out sort of between 5 and 10 years from now. While the EPA mandates were relatively low in 2023, by the time we got to 2025, at least the total mandate was above our prediction. And we talked about that last week. But then if you sort of project out based on this set of EPA mandates, you get back to a spot where we probably need to increase crushing capacity, and we're probably going to be in a situation where RBD basis starts to go wild again, somewhere in that sort of 4, 5, 6 years from now. And so while I think that canola oil use is probably going to be relatively minor, as we get into those kinds of situations, or if we have, a really short crop in the US this summer or any summer between now and whenever, then I think that then maybe canola oil probably works its way into the feedstock mix a little bit more. The other reason that I think you may have USDA, or the other reason that I think that canola oil feedstock use is going to grow a little bit more this year, I think, than we had anticipated a little while ago, is because, again, the spread between canola oil and soybean oil continues to contract. And so that should at some point make canola oil substitution for non-biofuel more attractive, and also potentially for biofuel more attractive. But I don't think it will be a situation where you have facilities, especially those that aren't located either close to the US-Canadian border or in sort of the Mountain West region or in along the West Coast. Those facilities probably aren't going to use a lot of canola unless we get unless there's a real shortage of soybean oil. They offset that increase with a decrease in their forecast for non-biofuel use. And I think they also made a little bit of a change in their forecast for exports. For Canada, USDA made a bunch of changes, and they were driven by 500,000 ton decrease in USDA's forecast for Canadian canola production. They dropped their estimate down to 19 million tons, which is still a little bit more than 850,000 tons, or a little bit less than 875,000 tons above where Stats Canada's latest estimate was. And that decrease then drove a reduction in their crush forecast. Let's see if these work. Maybe these work. Nope. I really apologize. I will try everything I can to get these fixed before next week. It drove a reduction in their crush forecast, and unlike recent reductions or recent changes in their crush and export forecast, we kind of had said that if we're going to change the demand side of our Canadian canola balance sheet, we probably are going to favor reductions in exports relative to reductions in crush. USDA kind of went the other way and cut their crush by I think it was 400,000 tons, if I'm remembering correctly. I think it was the majority of the decrease in production. It might have been a little bit less than that, but it was substantially more than they cut their export forecast. So their export forecast, they only cut by 50,000 tons. And the changes didn't take USDA's numbers substantially out of line with our forecast. And generally, I don't disagree, even though I still think crush will be preferred over exports. Based on the crush data so far for the year and the export data, especially for October, where we saw pretty big seed exports out of Canada, I think that at least for a little bit, probably holding exports relatively steady and then varying crush a little bit makes sense, especially because if you look at the pace of crush so far in 22-23, it's been certainly better than it was last year because of the drought. But what we haven't seen is a pace that looks like let's see, 2021, when they crushed a record almost 10.4 million tons. And so unless the pace really starts to pick up, and it looks like it is still kind of accelerating from the drought, but unless it really starts to pick up, I think that that we may have to trim our crush forecast just a little bit. I'm not expecting big changes, and if something happens and I need to cut production by 750,000 tons, I still am going to favor cutting exports rather than crush, because I think that there's probably the demand for the oil, even though it's less in the U.S. and so exports don't need to be quite as strong as I probably thought that they did 2 weeks ago. And the reduction in the crush then reduced Canadian canola oil production by 87,000 tons. They offset that mostly with a decrease in their export forecast, and so their canola oil export forecast. And so that all kind of fits together. I don't really have any big disagreement with that, and I don't think that our numbers are really substantially different from USDA's numbers on Canadian canola oil. On palm oil, we got the MPOB data last night, and palm oil stocks fell a little bit more than the market expected, and a little bit more than I expected. Not a huge amount more. I think it was 2.5% more than I expected. The decrease was mostly the decrease relative to expectations was mostly due to lower production, which production was in line with our forecast, but it was kind of substantially below market expectations. And even the estimates that come out of Malaysia during the month would have suggested a higher production number. And the problem with production, or not the problem, the reason that the production is trending lower than I think people are expecting is because if you look at the oil extraction rate, it's down again this year. And so it's down to about as low as it's been in at least the last 3 or 4 years. And the result of that is that even though if you back into the fruit harvest, those numbers are increasing year over year, because it seems like probably the labor situation isn't as bad as it has been over the last couple of years, certainly as bad as it was during the height of COVID. So you're increasing fruit harvest, but you're getting less oil per ton of fruit. And so that has made production come in a little bit lower than expected. And so if you are somebody that's out estimating the fruit harvest and then translating that into palm oil production, if you're using a higher yield, then you probably get a higher production number. And I think that that may be what's happening. And what it means is that I think that it will be hard to increase the production forecast over the course of the year. Now, I've cut my forecast for yield down a bit. And so if yield starts to come in above my expectation, then it'll be a little bit easier for me to increase my production forecast. But given the fact that the fruit harvest is already increasing, I think that it's not impossible, but it's hard to imagine that the fruit harvest is going to increase a lot more. That monthly fruit harvest number is all of a sudden going to really start to accelerate month on month, kind of, not relative to last year, but month on month, to make up for the relatively lower yield and production numbers. Exports came in just above where they were last month, which again was below market expectations and my expectation. However, it was the first time that monthly exports in 2 consecutive months were above 1.5 million tons since in about 2 years, basically. And it suggests that maybe finally the relatively wide spread between soybean oil and palm oil is causing some switching in importing countries. Certainly last month, there were stories about India's palm oil imports and how they had not started to restock. The stories actually said that they were substituting palm oil for soybean oil and sunflower oil because it was more competitive. But India is a different market than the futures market, but just based on the futures market, it should have been relatively competitive prior to that. And so I don't know if the strength is going to continue. Like, I don't think that you can look at the spread between soybean oil and palm oil and say that's absolutely the reason why India started to import a bunch of palm oil. And so they're going to continue to, and Malaysian shipments are going to be above 1.5 million tons for the rest of the year. However, cargo surveyor data for the first 10 days of December suggests that exports are still up, and it looks like, at least in the short run, that export demand is going to be relatively strong. And so if you have production that's probably going to be stable, exports that look like they're going to continue to be strong, and then domestic use was also relatively strong, then it seems more likely that the ending stocks number, probably, or expectations for 22-23 ending stocks, may be more likely to come down than to go up. Now, I've got ending stocks right now at 2 billion pounds or 2 million tons. And we've talked about how that is kind of the line, I think, at least sort of anecdotally, between a rising market and a falling market, that ending stocks below 2 million tons mean the market will rise relative to the level. Of course, if it's at 7,000 already, it's not gonna, but given where we are now, I think that if we start to really cut into that ending stocks outlook, then palm oil has the potential to rally, and has the potential to rally against soybean oil. Our forecast still sort of suggests that the spread, which for the most actively traded contract actually traded below 20 cents last week, then kind of bounced around that area a little bit, and then bounced back up to 28 cents over the last couple of days as soybean oil prices have rallied sharply. But I still think that spread probably comes in over the course of the rest of the marketing year and ends up at least in the lower 20s. It may be a little bit more than that, just depending on where yields actually end up over the balance of the year. So if yields continue to remain at the lower end of of my projections, and I have to cut them further going forward, then I think that maybe palm oil could rally a little bit more than I expect. And that's why you see sort of this rally in palm oil after we get through the seasonal decrease in production, is because if we all expect production to rise at sort of a normal rate through the summer to the peak in October, and the yields keep production a little bit more constrained, then I think, given the gap to soybean oil and the potential for ending stocks to fall a little bit more, or there's potential that ending stocks end up below 2 million tons, that all could support palm oil prices. All right. So for biodiesel, and this chart looks like it's updated. This is so weird. So last week, our assessment of biomass-based diesel margins actually accelerated. I suppose the recent trend sort of accelerated. And so you saw renewable diesel margins, or our assessment of renewable diesel margins, down pretty sharply, like by more than 40 cents a gallon. Conversely, you saw biodiesel margins up sharply, more than sort of 40 cents. And it was all due to the continuation of, and again, acceleration in a decline in renewable diesel prices in the California market versus especially versus biodiesel prices without credits, that have been declining, but much more slowly than renewable diesel, to the point where the spread between the two, biodiesel prices without credits, look like they are more than $1 a gallon above renewable diesel prices, which is just not something that we've ever seen before, and something that doesn't make a lot of intuitive sense, but this is where the market is. We forecast that the spread between the two will narrow, but we keep the premium for biodiesel through a lot of next year, because of the growth in renewable diesel production and the expectation that a lot of those producers are going to want to ship into the California market. Again, I think if the LCFS credit price is sort of $1 a metric ton above your marginal shipping cost, a lot of renewable diesel producers are going to continue to ship to California, even with LCFS credit prices at $65. And so I think that this trend in fuel prices probably kind of extends, and that's kind of reflected in our margin forecast going forward. We have renewable diesel kind of around its current level, which is, well, actually, last week it dropped below $2 for the first time in more than a year, I think since January or February of 2021. But we expect it to recover sort of back up above $1, around maybe $2.25, and then kind of slowly move lower and drop back below $2 by the end of next year. For biodiesel, we expect the margins to remain relatively close to the current level, which was around $1.50, and then to again slowly decline throughout the year. And the decline is due to basically sort of stable feedstock prices and slowly falling energy prices. And so if we get the renewable diesel price to start to correct relative to the biodiesel price, I mean, if it starts to more aggressively narrow the spread to biodiesel, then maybe renewable diesel margins will be a little bit higher. But given the growth in renewable diesel capacity and the likely rationalization of at least some biodiesel capacity, we still don't expect, significant rationalization of biodiesel capacity in 2023, or at least not until maybe the end of 2023. However, if margins for biodiesel stay above $1, it's going to be hard to get sort of any rationalization at all. And if that happens, then at some point, I think that that spread will narrow a bit and get closer to parity. Although, in order to do that, probably the renewable diesel price is going to need to go down to a level where it really does start to impact biodiesel prices and biodiesel margins. And that's tough to see right now. On the feedstock side, we've got feedstock prices that are mostly flat and maybe a little bit of an increase through the year. Again, a lot of where feedstock prices will go in the next 3 months or so will depend on South American weather. And then after that, we'll get into the U.S. growing season, and the prices will depend on the prospects for U.S. production. RIN prices. So again, the model really wants to predict higher RIN prices, and it also wants to predict a larger gap between D6 and D4 prices. I've tempered the increase in D4 prices, and so that's helped narrow the spread that the model wants to predict. But I've also raised D6 prices a little bit because the model basically wants to predict D6 RIN prices that are substantially lower next year than they are this year. And you can see I still have them sort of down a bit, although now for December, or currently, I think they're trading around sort of in the 130 area. So this really isn't that. This is actually sort of above where we are trading currently. And I don't know that D6 prices are going to be significantly lower next year. There's nothing. The only thing that I can think of that would substantially change for the ethanol market from last year to this year, from 22 to 23, is the potential for an increasing amount of ethanol capacity to switch to SAF production from ethanol, or go to ethanol to jet. And I don't know that that capacity is going to come online that quickly. If it does, then the D6 RIN would, the forecast for that would be substantially higher. The spread between D4 and D6 would be significantly lower, and the D4 forecast would probably be substantially higher, because if we take more ethanol production out of or more ethanol capacity and convert it to SAF, ethanol production probably declines maybe a little bit, and that leaves the gap between ethanol production and the mandate even larger. And so more biomass-based diesel needs to be produced to close that gap. Still, I think the point really for this chart really is that the model is kind of having a hard time forecasting, or at least the model, from my perspective, the output of the model isn't exactly where I want to be. And so I think that when that generally happens, or when it's happened in the past, there have been times that has sort of preceded kind of big changes in the outlook. I don't know that that's necessarily going to happen here, but just again, this is another area where I would say that this is my forecast, and I believe in it, but there probably is some risk to this outlook, and there's some risk that this outlook could change, maybe even significantly over the next several months. For LCFS credit prices, no change. We're still sort of trading around 65, and we've got them declining a little bit next year. But again, we think we're probably relatively close to that average marginal cost of shipping for the industry. And so we don't see huge further declines in LCFS credit prices. Conversely, we don't see big increases in LCFS credit prices either. One thing I want to say about LCFS credit prices in the sort of longer term, and I've been thinking about this and sort of turning it over in my head a bit. CARB is going to make some changes in 2024 with the idea of driving LCFS credit prices higher. And there's several things that they're considering, including sort of reducing their carbon targets, their carbon reduction targets, and so that credit creation is more difficult and deficit generation is easier as one way to kind of address the oversupply of the market. They're also considering a cap on the amount of biomass-based diesel that can be produced from vegetable oil or lipid-derived fuels. It's sort of like the EU has done. And I think that they will implement some combination of those to try to support the price and drive the price higher. And I think that there probably will be some success in driving the price higher. But I don't know that we're going to get LCFS credit prices back up to $200 a metric ton, at least through those kinds of changes. And not this isn't meant to be critical of what CARB's doing. What I mean to do is point out the difficult situation that I think that they're in. So if you get credit prices higher, it's more attractive to renewable diesel producers to ship more fuel into the California market, and then that presses credit prices down lower. Now, I guess there are probably some things that they could do that would be targeted at renewable diesel that could help mitigate some of that. As far as I know, there's nothing under consideration that would do that, or outside of a sort of a limit on renewable diesel shipped into the state. I don't know how they would do that. But as long as there is extra renewable diesel and extra biodiesel that can be shipped into California, I think any time that you get an increase in LCFS credit prices going forward, that probably the market is just going to beat it back down as it just attracts more fuel to that market. Now, when we already have the Oregon and the Washington markets, and as other states open their own markets and there's more competition, then the changes can potentially take hold and prices can rise and stay higher for a sustainable period. But until things change a bit from the current situation, I think in the longer term, so I think 24, 25, I may build a little bit of an increase into my LCFS credit price forecast, but I probably will trim it back down after that. And I don't even know how much of an increase I'm going to be able to build in. Right now, the industry ships something like 70% of renewable diesel output into California. Obviously, capacity is going to increase substantially over the next year. At least that's what has been announced, and that's what everybody expects. So that percentage is probably going to drop down. The more that percentage drops down, the more sort of fuel there is that can come to that market if the credit price starts to get too high. And not too high, but if the credit price rises substantially over the marginal cost of shipping. And so again, I think that in the past on this call that I've kind of said that, yeah, I start to see a recovery in sort of maybe late 2023, and then 2024, they implement these changes, and then we start to build from there. And I'm starting to have a bit of a rethink about that, and about what the sort of longer term credit price is. In the short term, it seems relatively easy to forecast the LCFS credit price, and it's just 65 going forward. Of course, now that I've said that, they'll probably drop to 20 next week. Okay. With that, if anybody has any questions, I would be happy to answer them. And if not, I hope that everybody has a great week, and I appreciate you coming every week. For the holidays, we won't have the webinar the week between Christmas and New Year's. A lot of people are probably out that week anyway. We probably won't I won't write a report that week either. And so I'll remind you about that again as we get closer, but we're only a couple of weeks away now, so I wanted to bring it up. All right. I hope everybody has a great week, and I will see you all next week.